Hello. So today we are going to overview very briefly the issue of economic integration. So as you probably know at this point, from very general perspective, we can define economic integration as increase in the scope and scale of economic cooperation between separate national economies. Following this idea, Balassa, in his famous definition, sees economic integration as overcoming discrimination when it comes to international economic cooperation. So when integration is analyzed as the process, we are talking about removal of various discriminatory policies against actors in the world economy. So for instance, it can be related to removal of barriers to trade, investment, and so on and so forth. However, when we treat economic integration as the state of affairs, we assess the degree of economic integration by the absence of discrimination described before. However, we're going to discuss it in a second, you will see that this approach is a bit of limited. So another thing is that economic integration is usually viewed as the process consisting of two pillars. So first, the required condition is removal of different administrative barriers or the cases of discrimination discussed before, like tariffs, quotas, subsidies, qualitative restrictions on international trade, barriers to investment, and so on and so forth. And second, it requires some economic incentives for participants of international economic exchange to benefit from removal of these barriers. So for instance, two countries have to how to say it. Okay, so if we have two countries and they enter the same free trade area, it implies that there are no administrative barriers to trade between those two countries. At the same time, there is no guarantee that they will use this opportunity and the volume of international trade between them will increase. So there are some other conditions to be met as well. So when it comes to measuring the degree of economic integration, honestly, there is no single variable. So based on a very brief overview of papers, you can see various measures of economic integration. So for instance, it's measured as trade liberalization, for instance, number of non-zero tariffs, where higher number of non-zero tariffs is associated with a lower degree of trade liberalization. But again, if you keep in mind this distinction, that it includes both removal of administrative barriers and using the opportunities implied by removal of administrative barriers, you will see that this measure captures only the first pillar. Trade facilitation, which includes the uniform system of certification, conformity of the uniform standards and rules. Actually, it's kind of interesting because since the development of general agreement on trade and World Trade Organization, it's kind of hard to impose additional tariffs. So qualitative restrictions on international trade are viewed as the new trade protectionism. So the idea is like this. Even though European Union might not impose any tariffs on the goods imported from, let's say, emerging or developing economies, it's still possible to impose qualitative measures. Like requirements regarding quality, certification, and so on and so forth. So on one hand, it can be perfectly justified by considerations of safety and so on and so forth. On the other hand, it works as the very efficient tool of trade protectionism. So in this case, uniform system of certification and uniform standards of quality might be viewed in the same way as trade liberalization. On the other hand, as I mentioned before, this measure will capture only the first pillar or the first aspect of economic integration. It will tell you nothing whether parties engaged in international trade actually use this opportunity associated with removal of barriers to trade. Another thing is monetary/economic convergence, which is measured in terms of similarity of inflation rate, size of budget deficit, and size of public debt. So actually, even if you analyze the policy of European Union with this perspective, you will see that countries assessing European Union have to meet the range of requirements regarding size of public debt. As far as I remember, no more than 60% of GDP, but I might be wrong, you can easily check it. Inflation rate, size of budget deficit, and so on and so forth. On the other hand, it basically just describes to what extent countries are similar in terms of financial and real economic environment. Again, it provides little evidence regarding the actual degree of economic integration between the states. Okay, so we can also analyze similarities and discrepancies in terms of domestic payments and settlement system. Again, like banking and exchange rates. It will also include restrictions on the current account transactions and restrictions on capital account transactions. So for instance, in some countries you can still see some barriers to outward and inward international investment, let's say. But again, as I said before, it captures only the first pillar of economic integration. You can also analyze similarities and differences in terms of fiscal environment, measured, for instance, just some suggestion, based on literature review. Average income tax rate, value added tax rate, and size, like relative size of government expenditure. But again, it's hard to say whether these indicators indeed can describe the degree of economic integration. And finally, you can analyze similarities and differences in regulatory environment. So it is related to all the possible kinds of legislation, for instance, when it comes to business, international trade, and so on and so forth. So again, as you can see, there are a lot of possible measures of economic integration. Sometimes they even include size of mutual international migration, volume of international trade, volume of international investment between two countries. But again, I wouldn't say that all of those measures are perfectly conclusive. So in simple words, like different authors use very different measures of economic integration, and none of them is 100% good. Except of perhaps business cycle synchronization analysis, but we will get back to this. So, when it comes to the stages of economic integration, Balassa distinguishes between 5 possible stages, which are free trade area, customs union, common market, economic union, and complete economic integration, whatever it is. So free trade area, I believe, is the most intuitive. So it simply implies the absence of restrictions on international trade. At least quantitative restrictions. I mean, like tariffs, quotas, and subsidies. So this one is pretty simple. And obviously, like, those stages of economic integration are placed in the ascending order. So customs union will be characterized by the higher level of economic integration than free trade area. common market will be characterized by the higher level of economic integration than customs union. So it will incorporate all the features of customs union and so on and so forth. So when it comes to customs union, it implies the absence of restrictions on international trade plus common external trade policy. So this one, I believe, is easier to analyze based on this illustration. So Poland and France are in free trade area in European Union. Like formally speaking, they are the part of the common market, but as we discussed, common market also includes free trade area. So basically there are no restrictions on international trade between Poland and France. And then we have Belarus, country outside this free trade area. So imports from Belarus are subject to 10% value added tariff in Poland and 40% value added tariff in France. Actually, I have no idea. Sorry, ad valorem. Ad valorem. I meant ad valorem tariff in Poland and 40% ad valorem tariff in France. I have no idea about the actual size. This is just an illustration. So it does not imply that those numbers are true. But yeah, the idea is like this. In Poland, goods produced in Belarus are subject to a smaller tariff. That's why actually it makes sense to Belarus to export goods in Poland and then from Poland export them to France, because there are no restrictions on the flow of goods from Poland to France. So in order to prevent this, customs union also implies common external trade policy. So all the countries which are the part of customs unions charge the same tariffs when it comes to external countries. So in this case, for instance, it makes no sense for Belarus to export goods to Poland and then to France, because in this case both Poland and France have the same tariff for Belarus. So basically this is the idea of customs union. Common market includes all the aforementioned features, and also common market means the absence of any restrictions on the international flow of production factors, basically capital and labor. So free migration, free international investment, and so on. So when it comes to economic union, Balassa describes it as no restrictions on commodity and factor prices, whatever it is. But basically, as he explains, it implies that national governments do not impose, any national policies when it comes to commodity and factor prices. So for instance, if there are minimum wages, they should be uniform in all the countries constituting economic union, something like this. And finally, complete economic integration implies full synchronization of fiscal, monetary, and social policy. So fully synchronized fiscal policy, the same taxes, the same size of government spending, fully uniform social policy, the same size of retirement benefits, unemployment benefits, and so on and so forth. And monetary policy synchronization basically means a single currency. So in different textbooks, you might also find some alternatives to the classification I presented before. So usually, like when it comes to free trade area, customs union, and common market, so it just remained the same. But usually authors of the most popular textbooks discuss fiscal union, monetary union, and political union. And the idea is like this. Fiscal union should occur before monetary union, and monetary union should occur before political union. So fiscal union basically means full business cycle synchronization. So there are no asymmetric shocks, there are no discrepancies in terms of government spending, public debt, and budget deficit, and so on and so forth. So basically it just implies fully synchronized fiscal policy. Okay, I believe, yeah, okay, no, it's fine. Monetary union means fully synchronized fiscal policy plus single currency and monetary policy synchronization. And finally, political union implies common legislation and social policy. So, yeah. I believe that on current stage, European Union kind of tried to achieve political union, by introducing some uniform legislation and so on and so forth. This initiative kind of failed. And when it comes to monetary union, in European monetary union, this stage was achieved way before fiscal union. So, they just shifted from common market immediately to monetary union. So at this stage, there is no full fiscal synchronization among the members of European Monetary Union. And probably that's why it was so problematic. So it was, and it is still so problematic in the European Monetary Union. Okay, so the theory of optimum currency area suggests that optimum currency area is such a geographical region when costs of single currency are minimized and benefits of single currency are maximized. So the most typical characteristics of optimum currency area described in the literature are openness with respect to international trade, labor and capital mobility across the region, the mechanism of fiscal policy synchronization, and business cycle synchronization. So I believe that those two are kind of intuitive. So when it comes to the mechanism of fiscal policy synchronization, so it's suggested that there is some efficient mechanism of direct transfers which are used in order to prevent asymmetric shocks and business cycles asynchronization. So, okay, put it in this way. You know that during recent global financial crisis, Germany was doing relatively well and Greece wasn't doing well at all. And one of the reasons behind this was that Germany was and is characterized by the very high degree of fiscal discipline. So they have low budget deficit, very low public debt, obviously there should be some public debt, but its size is relatively small in comparison to what you can see in the majority of modern economies and so on and so forth. So basically Germany had enough funds in order to cope with the consequences of a global financial crisis. Greece didn't. And actually this was the problem. So obviously there was some transfer from Germany to Greece, which was used to repay public debt, like to decrease this pressure on government bond yields and so on and so forth. But it wasn't really perfect. And when it comes to optimum currency area, it's supposed to be perfect and efficient. So business cycle synchronization implies that at some point of time, countries constituting the optimum currency area are at the same stage of business cycle. So as you remember, there is some potential output trend, and usually GDP kind of fluctuates around this trend. So there are periods of economic boom, economic recession, and then everything starts from the very beginning. So usually the estimated length of business cycle is from 3 to 7 years as far as I remember. So it's not really long. So the idea is like this. If there is recession in one economy, there is recession in the rest of economies constituting this area, and vice versa. Like otherwise we deal with asymmetric shocks, and in this case it can be kind of problematic, especially in the absence of control over monetary policy, because this is what implied by the optimum currency area. This is what implied by single currency area. So obviously There are benefits of adopting a single currency, and in European Monetary Union there was quite a long period of prosperity. Because, nothing really happened in the world which could affect countries in European Monetary Union. Everything was nice, everything was stable. So they benefited from decreasing transaction costs, basically caused by elimination of exchange rate risk, a higher degree of price transparency. So basically consumers from different countries could easily compare prices in different countries, which facilitated arbitrage and prices equalization. As a result, there was higher volume of international investment and higher volume of international trade. And as you remember, usually international trade is beneficial for all the countries in general. At least this is Pareto efficient. Okay, this is not always Pareto efficient because you also have Heckscher-Ohlin model. But nevertheless, international trade increases total volume of consumption in countries engaged in international trade. So this would be more accurate. So obviously there are benefits, and the major costs are losing the control over domestic monetary policy and asymmetric shocks. So when it comes to losing control over domestic monetary policy, I think this course also covers ISLM balance of payments model. So you have either discussed it with Dr. Beck or you will do it very soon. So basically, if a country is a part of a single currency area, so we treat exchange rate as fixed exchange rate. So this means that central bank cannot use monetary policy in order to fix some real shocks. And also we deal with asymmetric shocks. And asymmetric shock occurs when two countries react very differently to the same shock. So for instance, in country A there might be deflationary trap when output is below potential output and price level decreases, and it can be just the opposite in the other country. So basically, in this case, two countries are at the very different point of their business cycle, which obviously implies that business cycle is not synchronized. So again, for instance, like it was in Germany. So they had enough funds in order to, get back to the normal situation pretty quickly, and in Greece it wasn't the case. So Germany was exactly in equilibrium or very close to equilibrium output, and in Greece there was a deflationary trap. Because I changed the ID position, so probably you can guess now it's a deflationary trap. So this is the idea, monetary policy cannot serve as the efficient tool of fixing this gap, because as I said, in two countries you have very different situations, so it's not exactly clear in what way public authorities should use monetary policy. And when it comes to fiscal policy, Greece had very limited opportunities to use it because of high level of public debt and budget deficit. So yeah, as the result, you have a kind of a dilemma. Okay, so that was a very brief introduction to economic integration, and thank you for watching.